Hello and welcome to a session where you will learn about journal entries. Journal entries are the very start of the accounting process. This is where you get your receipts and all your invoices and you start putting them into the system or your manual system. Some will use a spreadsheet, some will use an accounting package. So if you ever go shopping and you get those little receipts, that little receipt will go into your purse or your bag or your pocket, and from that receipt then you will type it into what's called a journal. A journal is very similar to a diary. Like if you were to keep yourself a personal journal, you would write your thoughts and ideas and your on a piece of paper, and you keep that each day. Well, this is what we call financial journals, where you've spent money or received money or made a promise to someone and you want to keep track of that. And what I mean by a promise is you promise to take some goods, which you have. You promise to take some goods, which you have, and then you promise to pay them back. So that's a promise. So how do we keep track of those promises? How do we keep track of the money we received? How do we keep track of the money we spent? So today we've got an activity called Brad's Bar and Grill. On the left hand side we have all the little individual transactions that happened over the month of March, and on the right hand side over here we have the four journals. We have the cash receipts journal, the cash payments journal, the sales journal, and the purchases journal. For your purpose, you have the two tabs which has both. Now for training purposes, I have split my screen so we have all the individual transactions, and then on the right we have the journals. Okay, so the first step you have to do on the left hand side, which I've already pre-done so you understand, and I've color coded them, so is identify which transaction is which. So the yellow one is this one. The cash payments journal, the CPJ, the CPJ is orange. I've done that wrong, so I'll put that correct now. CPJ. Okay, so there I have my, and then for sales journal SJ, we have red, and purchase journal, we have PJ. And as you can see, I have put it as CP, cash payments. We'll go with theme, JP, PJ, sorry, PJ, PJ. Okay, so let's focus on the yellow one. So cash receipts journal. What that means is cash being received, money coming into the business, physical money coming into the business. Generally it's either cash being put into your hand or an electronic transfer into the bank account. In the good old days it used to be checks, but they don't exist as often these days. So there are generally three forms of ways you get money, either physically in the hand, the checks, these days credit cards, but that's again the deposit in the bank account. So there's a variety of ways in which we receive money. We can receive money by our customers for a cash sale. So if you're in a retail store, someone would give you $50 for a t-shirt, you put that into a cash sale. We can receive money from a customer, again another cash sale. We can receive money from a customer that we gave credit to. So I give my customer some stock, and they pay me back in 30 days. So it's only when I receive the actual cash do I record it. So I gave them $1,000 worth of stock, and in 30 days they gave me 500. So then I would call that the cash receipts journal. Physical money I've actually received. Again, another cash from a first customer. Now I've actually sold some equipment for my business. That's not really normal expenditure. I might have sold an office table or computer. Not my everyday run-of-the-mill sale. I need to record that. I've received some cash. Again, another customer. Yeah, I've got some from a customer that I gave credit to, and another. Okay, so there's three different types of ways we receive money, either from cash from a customer, cash from a customer that owed us money, we sold some equipment, and the fourth one, which is not in this example, we could also, the business owner could put cash in the business. So that's again the business receiving money, cash receipts journal. So I'll put the first one in. I've already pre-done it. So this is how it works. I'll put the date, corresponds to the date up there. What sort of thing? It's a cash sale. It says there, we know it's a cash sale. The CRT, cash receipts transaction. Accounts receivable. Accounts receivable is, did I get that money because someone owed me the money? No, it was a straight out transaction. They didn't owe me the money. They came to the store and they just gave me cash. And then, how much did I receive? I received 8,800. But not all of it is a sale. Only 8,000 is a sale. The other 800 is GST, because we have GST now in our prices. So we need to split them up for reporting later. So 8,000 is a sale, and 800 is the GST. What actually went in my bank account was a total of 8,800. I collected the whole 8,800, and then I put that in my bank account. And so there might be other amounts and other accounts, but we'll go through this in the later stage. So that one is done. So I go to the next one. So 10th of March, corresponding date, still a cash sale, still CRT. Okay, so what we've got here is $9,000 cash sale. We have to split it. 9,000 is sales, 900 is GST. Now notice it's blank there. The reason it's blank there is because I have another transaction on the same day. Because what would normally happen is you receive all the cash in one day and then you bank it at the end of the day. So that's why we don't put the total there. So let's do the next transaction to see what happens there. So in this case, receive money from RSVP. He's a debtor, so he owed us money. So RSVP, and we record a receipt of 2221 and received $9,900. In this case, you do not worry about the GST because that has already been taken care of in another transaction, which I'll show you later. And then it's this amount plus these together give us the deposit amount. So as you can see, it's not a running total, it's just what these equal up to. Yeah? So, because when I go into my bank statement, this is the amount I'm going to see in my bank statement, not the two individual ones here. I'm going to see this total. That's why we do the banking at the end of the day. I'm going to go to the next one. Get into that. So in this case, another cash sale on the 15th. Got that just here. We've got a cash sale, CRT, then we split up for GST, and there is nothing there. So, well, there's another yellow one there. So that's why it's important to do the colours first, and we concentrate on the yellow ones first. And then again, this time we sold some equipment, but it's nothing to do with accounts receivable. It's not really a sale. It's just some equipment we sold. And this is the account. This account here. So let's just show you where we are. We are just there. Sold equipment, our own business equipment. Because we're a bar and grill, we're not in the normal business of selling equipment. We're in food and wine and beverages and so forth. So it's that added by that gives us this total. Now it's equipment. Now this account is all those things that you see on the profit and loss statement, like equipment, sometimes the balance sheet, equipment, stationery. So these tells me which account to charge later down the track. And we keep going. So we've got cash sales. Again, 20th of March. Balance. You can see the yellow line there. That was done. Then we go to the next one, which we received some more money. Same principle again. So the date, the type of transaction is CRT. Split the GST up, and we don't do the total because there must be another transaction on the 25th. So we look, yes, there is. We received some more money from a debtor. There it is there. So we can highlight that. Yep, so we received a debtor. Again, we don't have to repeat the date because it assumes that it's the same date. The receipt number, how much in total this time because it's accounts receivable, and then those two added up together. And then we continue. So now we've got this one, the 30th of March there. So customer, the cash sale, $6,600, so we split the GST up, and $6,000. Then we can do our totals. Where they all add up together? Where they all add up together? Those, you add those up, you add those up. So that is the cash receipts journal. So now the yellow part is done. Now we come down to cash payments. So this is where anywhere where you've spent money from your business. You've taken physical cash and you have given it to someone, or you've gone into your bank account and you physically transferred money to someone. So this is money physically going out of the business. So we've made that orange. You can see there's a few orange there that we've identified as cash payments journal. So the first one we've got here is the cash purchase of $7,700 for stock. Okay, so it's definitely a cash purchase. Who we get it from? The check number that we wrote. Not all the time will we have a check number. Sometimes it will be EFT. And then again we break down the GST. We take out the GST. So 7,000 is actually the purchase. 700 is for GST. But what actually came out of our bank account is the total of that together. Now in cash purchases, every transaction has a total compared to cash payments where we total up at the end of the day. If it happens to be a transaction happens on the same day, it doesn't matter. We do add up every line item. So next one is, again, same date. We don't necessarily change the date, we can leave it blank there. Same check, but this time it's rent. It's got nothing to do with actual purchases of goods and stuff. And this is the account, so we want to know what it's for, and it's for still we account GST. The amount is 2,000, GST is 2,200, and the total that came out of my bank account was 2,200. Okay, so we go to the next one. Withdraw. This is an interesting one. Withdraw. The owner, Mr. D. Gum, took out money from his own business. It's still a cash payment to the owner. Just even though he owns the business, he is still getting some money out of it. So still do the date, who it went to, the check number. Generally they go in sequence, not always. But that was the idea, is to keep them in sequence. And this time it doesn't have any GST. Anything to do with owners giving them money doesn't attract GST, because GST is about making us goods and services. And drawings doesn't apply to that. So, and we do the total. Voila. The next one is data drawings. Again, this was paid for equipment this time. Yep. Where we got the equipment from, the check number. But my equipment does have GST. And then we put the equipment just like there. So you can see there's a connection between those two. And the total of that. And then we keep going. On the next one, paid. So this was AGL, so it's power. So we got the date, we paid, the check number, the GST and the amount. Power is the account for about 140 in total. Then we do the next one. RAT 131, accounts payable. So this is slightly different. Okay, so this is where someone's given us credit, they're giving us stock, and we don't pay for it later. So here we go. RAT said, okay, now we can give him his money. And so we write a check and we give his money. It's like getting a bill and we write it for it. And then the total at the end. Then we've got the 25th, we've got cash purchase again. It's just a baker. Again, we split up the GST and it's 7,700. In this case, we do not do the GST, which I'll explain in the next step, my next steps. And then we keep going. D-gum, 25th. Just there. That's why it's good to color code again. Always good to start that step. And this time, taking money out of the business again. So drawings, $460. Again, no GST component. We want to track where the drawings is. And then the last one is staff wages, which is just down there. And the wages does not track GST either. So it's just a matter of the date, where it went to the staff, check number, the total amount, wages, and how much came out of the bank account. And then we total that up once it's all done. Like magic. Okay, so they're the first two, they're the biggest ones, and now we go to the next two. Sales journal. This is items that have been sold on credit. So someone's come into your store, or you've got an arrangement with someone where they get the product and they pay you later. Okay, so let's go find all our SJs. So we've got there, one there, got one there, got one there, and got one there. So there's no exception to this rule. It's only sales. So it's only one type of transaction. So here we go. So we'll do the first one. So you wait the date, who you make the sale to, the invoice number, and you break up in the GST there. This is where you account for the GST. Whereas before, you'd make the sale, and then you receive the money from one of these. Not that that's the right customer. But then, say for example, we call the seller, we call the GST there, and then when I receive this money of 12,100, I put the 12, for example, I put the 12,100. I don't have to worry about the GST this time. So that's the difference. The GST gets recorded when you make the sale. It doesn't matter if you haven't received the cash yet. We record it at the sale point. And then we go to the next one. So the burger, 5,900, and then we pay 12,000, 3,200, and then you do your totals. Voila. Now the last one is purchases journal. This is where someone comes into their business, gives us stock, and then we pay for it later on credit. Okay, also known as credit tools, also known as debtors. Yep, debtors, creditors. Okay, this one we have to focus on the green ones, which we've predetermined. So there we go, 1, and there's 2. So again, pretty straightforward. There's only one type of transaction, which is giving credit. So voila, and voila. So tasty meats. Oops, didn't do the total there. Taking the rest of this one. Okay. And then the total of all that. Total of that. Total of GST paid. Total of course invoice numbers. So you have finished your journal entries. And that is the end of the exercise.